Ladies and gentlemen, good day and welcome to the business update call hosted by Asian Energy Services Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touch-tone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Kapil Garg, Managing Director from Asian Energy Services Limited. Thank you, and over to you, sir.
Thank you. Good morning and a very warm welcome to everyone joining on this call. Asian Energy has always stood at the intersection of technical expertise and strategic foresight. Over the years, we have built a reputation as a trusted partner in the oil and gas and mineral industry, delivering seismic surveys, integrated field development, EPC projects, enhanced oil recovery, and long-term O&M solutions. Today marks a defining milestone in this journey. The Board of Directors have approved a scheme of merger by absorption through which Oilmax Energy Private Limited will merge into Asian Energy Services Limited. This merger is a transformational leap forward that builds a larger, stronger, and future-ready Asian Energy, positioning the combined entity to bid for large integrated projects across field development and management, O&M, well drilling, and related services, while strengthening our ability to emerge as one of India's leading integrated energy and minerals company, delivering sustainable value to all stakeholders. The merger will be further bolstered by the addition of Kuiper Group. Earlier this year, we had announced the acquisition of Kuiper Group, an oil and gas service company based out of UAE, and I am pleased to inform you that earlier this month, the acquisition has been completed. The company, which is running O&M projects all across the Middle East and Southeast Asia, will open up opportunities for the combined entity to expand integrated projects across international geographies. Before I move into the transaction details, let me give you a brief on Oilmax Energy Private Limited, its journey, business model, and the assets it brings into this merger. Over the years, Oilmax has created a diversified portfolio of low-cost, low-risk discovered assets with a strong focus on onshore and shallow water blocks where unit cost per barrel remains lower and competitive and monetization timelines are short. The strategy has consistently been to avoid high-risk exploration, preferring assets with proven reserves, quick cash flow generation, and prudent capital deployment. The current Oilmax asset portfolio is, we have a field in Assam called Amguri. It is producing and a rapid scale-up has been demonstrated in the field. In the Aurora field in Gujarat, the steady onshore production, future development to begin soon. Dwarmara and Tipuk are the two fields in Assam, both discovered blocks under development, having upside potential. We also have a coal bed methane block, which is an unconventional gas asset with long-term visibility. And diversification into minerals resulted into a quartzite block in Uttarakhand. Together, these assets provide a balanced mix of producing and development fields across hydrocarbons and minerals. The merger creates a natural synergy between Oilmax's asset ownership and Asian Energy's technical and project execution expertise. Oilmax contributes producing and development assets. Asian Energy brings proven expertise in seismic, EPC, O&M, and enhanced recovery. Additionally, Kuiper opens up opportunities to expand our services into international geographies. By combining the two, along with the Kuiper acquisition, we are building a closed-loop integrated platform spanning exploration, development, production, and long-term field management. This enables a combined entity to improve execution speed and strengthens operating efficiency across a diversified client base spread across multiple geographies. Looking forward, the merged entity is uniquely positioned to capture opportunities over the next 5 years. Rising energy and commodity demand, India's rapid economic growth, industrialization, and technological advancement are driving rising demand for oil and gas and mineral commodities to fuel the world's fastest growing major economy. Supportive policy environment and reforms. The government of India has been doing transformative reforms such as unlocking 99% of CRZ area for exploration production. The Oil Field Regulations and Development Act, along with increasing policy support, are driving higher domestic production and advancing India's goal of becoming Atmanirbhar Bharat and energy independence. The third point is increasing private footprint in the industry. Initiatives such as discovered small fields, production enhancement contracts, and open acreage licensing policy, along with national monetization pipeline, are expanding the private sector's role in the industry with a rising share of mineral production helping meet growing demand. The last point opportunity is the critical and base minerals in India and across the world. There is a growing demand for minerals to power new energy industries and enhance self-sufficiency in being met through increasing auctions of base and critical minerals across both India and the global market. This positions us strongly not just in oil and gas but also in minerals, broadening our growth runway. Our progress is already evident. Asian Energy recently secured a 865 crore order from Vedanta, demonstrating our ability to deliver large complex assignments with scale and reliability. The merger is guided by four clear objectives. Number one, strategic fit and business synergies. The merger integrates strengths across oil and gas, minerals and upstream services by combining Oilmax's O&M and EPC expertise with AESL's Oilmax's reservoir and field development capabilities, creating a diversified portfolio that ensures long-term revenue and cash flow visibility. Second point is growth and market leadership. The merger creates a leading Indian energy and mineral company with a global footprint, providing a stronger platform for expansion, sustainable growth, and global competitiveness, while enhancing the ability to leverage combined assets, technical capabilities, and operational expertise. Third point is operational and cost synergies. It enables economies of scale through shared resources and streamlined processes and ensures optimized capital allocation and cash management. Number four is financial strength. The merger results in a strengthened balance sheet with a large net worth and asset base, enhancing borrowing capability, reducing cost of capital, and enabling better capital utilization and financial flexibility to fuel faster growth with improved cash flows. With that, let me now invite our Chief Financial Officer, Mr. Sumit Maheshwari, to take you through the financial aspects of the transaction. Sumit.
Thank you. Good morning, everyone. Let me take through the key financial aspects of the proposed merger. In the current structure, Oilmax Energy currently holds 60.83% of Asian Energy Services Limited. On the fully diluted basis, it's roughly around 55%. The merger scheme. Oilmax will be absorbed into AESL. Oilmax shareholding in AESL will be cancelled and new AESL shares will be issued directly to the Oilmax shareholders in exchange based on the approved swap ratio. The valuation parameters. The swap ratio has been determined by independent SEBI registered valuer, Bansi S. Mehta Valuers LLP, using multiple methodology, risk adjusted DCF for Oilmax producing and mineral assets, plus NAV of Oilmax other assets, market based approach including the ICDR price line for AESL being a listed company, and income and cash flow methods wherever applicable. The fairness opinion has been validated by independent advisors, ensuring equitable treatment for all the shareholders. Post-merger impact. Oilmax indirect shareholding in AESL will be extinguished and its shareholder will hold shares directly into the listed company. All assets, liabilities, contracts, employees, approvals of Oilmax will vest into AESL as a going concern. The entire Oilmax will be consumed by AESL. Oilmax will stand dissolved without winding up. The scheme is fully compliant with the tax and regulatory requirement. The expected timelines to complete the transaction. The process is expected to take roughly around 12 months, subject to approvals from stock exchanges, SEBI, NCLT shareholders, creditors, and any other regulatory authorities. Looking ahead, the pro forma merged entity for FY25 reflects a net cash balance sheet strong EBITDA margin, healthy ROCE and ROE, and the financial flexibility to fund the growth to drive the business to the next level. To summarize, this merger consolidates upstream assets and services under one roof, creating a large, more diversified platform with scale, resilience, and growth potential. Asian Energy is poised to emerge as a leading integrated energy company in India with the scale, resilience, and vision to expand its presence globally. Thank you for joining us today. We will now open the floor for questions. Thank you.
Thank you. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Balasubramaniam from Arihant Capital. Please go ahead.
Good morning, sir. Thank you so much for the opportunity. Sir, I just want to understand the integration on the execution side. The merger combines an asset-heavy production-focused company like Oilmax with capital-light service-focused company Asian Energy. And what are the specific quantifiable operational synergies beyond streamlined processes? Is there any cultural clash between E&P risk, taking mindset, is there any project execution side? And client services, and how we are going to streamline on the integration and execution side. So my first question.
Thanks, Bala. So to answer your first question, Oilmax business is also not an asset-heavy business. As we explained, Oilmax business, we are focused on discovered and developed assets. So Oilmax business is also a very asset-light business, where conventionally we have focused always on very discovered and very low capex business model. So and we'll continue to work on the similar manner. Second terms, in terms of the cultural organization, integration and everything, currently both of the organizations are already working on a couple of the projects together, where they are partner in Indora, and Oilmax Asian is already providing services to Oilmax on Amguri, and the senior management at a couple of the places are common. So as a management of both the company, we'll chalk out the plan for a proper integration of both the teams, so that the overall synergies comes into the play, and when the merger, after all the approval gets concluded, both the companies' shareholders gets benefited.
Okay, sir. So I think recently we got Vedanta order. I think this one of the major catalyst. Could you please detailed breakdown of these projects, and what specific roles did for Oilmax and asset expertise and Asian Energy execution capabilities plays in these projects? And is this a replicable model for future large contracts? And if you could share what is the total addressable market for such composite assignments?
Yeah, you asked about the Vedanta contract. So Vedanta contract is basically implementation of the full field development plan approved by the Government of India for the field. It includes drilling of new wells, build facilities to connect the new wells, and then operate the whole field for. So basically, as I was explaining in my talk earlier, Oilmax brings the subsurface modeling expertise and the drilling expertise to the table, and Asian already has proven expertise in the operation maintenance services. By combining the two strengths, we have been able to offer this package service to Vedanta. The second part of your question, we would definitely hope that this will result in a highly optimized model which most E&P companies will start following going forward.
Okay, sir. And sir, I think Oilmax Energy's margins are much higher compared to Asian Energy. I just want to understand how these margins post merger will look like, and is there any sensitivity of this margin? It depends on oil prices.
I mean, combined entities of going forward, the combined margins are definitely going to be superior. As far as our second question is concerned, oil prices, yes, there is some correlation, but not exactly correlated. As Sumit was explaining earlier, we focus on low cost operation fields. So we are not very sensitive. In fact, Vedanta contract, we are neutral to oil price, a service contract. It has nothing to do with the oil price.
Sir, I'll come back in queue for further questions.
Thank you.
Thank you. A reminder to all participants, you may press star and one to ask a question. The next question comes from the line of Vaibhav Mishra from Finvestors. Please go ahead.
Hello, sir. Good morning. Sir, I have two questions. First is, could you please provide the revenue and EBITDA numbers for Oilmax Energy for the previous years like FY23, 24? FY25 you have already given, so 23 and 24, could you please?
Weber will provide you separately. Currently, we do not have those numbers handy with us.
All right, sir. All right, no issue. And second question, sir, is for FY26, we had targeted revenue of around 650 to 700 crores and EBITDA of 110 to 120 crores for Asian Energy alone. Now, with the Oilmax merger, what revenue and EBITDA or EBITDA margins we are targeting for FY26? And also, apart from these two, if we add Kuiper into this, then what numbers can be seen FY26 expected?
So, Vaibhav, as I explained on the call, the merger process will take between roughly around 12 months to complete. So, even if taking the 12 months into the picture, the merger will get completed only by next September, October. So, FY26, we will have only Asian numbers. The Oilmax numbers will start getting consolidated only post the merger is done. So, we'll be able to provide those numbers and clarity going forward after that. And as far as Asian numbers are concerned, we have already provided our guidance earlier, which remains same. And Kuiper, we have completed acquisition only on last week, 1st September. So in the due course, we'll revise our guidance, including the Kuiper numbers for FY26.
All right, so okay, so no issues. Sir, but Oilmax number for FY26, what we are targeting or what we have in sight for Oilmax in FY26 alone?
As we are showing a good growth in Asian numbers also from the last year, Oilmax is also a growing company. So definitely Oilmax numbers will be growing. But I think it's slightly premature till the merger completion and the other formalities get completed to provide Oilmax numbers.
All right, sir. All right. Thank you so much, sir. And all the best.
Thank you.
Thank you. The next question comes from the line of Siddharth Chauhan from Batliwala and Karani Securities. Please go ahead.
Hi, sir. Thank you for the opportunity. So in terms of Oilmax, just want if you can provide some field level operational details, like what is the current production and how do we see it going ahead as well? Is it possible to share these details?
Yeah, I can give you the basic data. I mean, as I went through the list, we have multiple fields. Let's start with Amguri field in Assam. So Amguri, as on today, produces about 220,000 cubic meters of gas per day, along with 300 barrels of condensate. And there is a workover planned in the near future. The problem in Assam has been, as I'm sure you track HOEC and other companies, historically the problem has been the gas has been bottlenecked due to infrastructure or pipeline constraint. So later this year, we are hoping to get connected to the Indradhanush gas grid. And in anticipation, we are looking to ramp up production significantly from Amguri field. The other field is Dwarmara, where drilling is going on. And we anticipate that the field will come into production later in the year. Same situation is with the Tipuk field. Tipuk field already has proven gas and it has wells which are ready to produce. We are in the process of connecting those wells with a workover rig getting there next week. And we are again hoping to bring that field into production in the near future. Indorara field in Gandhinagar is already producing. It's producing about 100 barrels a day, and we are going to start a drilling campaign within the next 1 month and start ramping up production from there.
Okay, understood. And sir, just wanted to understand in Assam, so is the plan to connect the gas pipeline to the DNPL expansion to supply it to either Numaligarh or to pass it through to the IGGL phase 1? What is the plan for that, sir?
So yes, you are right. I mean, ultimately we'll connect to both DMPL and through DMPL into IGGL. So we are looking into two tracks. One track is later this year we will get connected into the Numaligarh refinery network, and from there into IGGL. In parallel, Assam Gas Company will be laying another line to connect directly to DMPL.
Understood. But just to clarify, that
I'm sorry to
pipeline
interrupt, Siddharth. Could you please rejoin the queue for further questions?
Can I just ask a follow-up and then I'll
Okay.
rejoin for further questions? Is it possible? Right.
Sure.
Sir, just to understand, that DNPL pipeline, isn't it a dedicated pipeline? Will we be able to use that?
So it's in the process of being converted into open access, and as you must be aware, it currently transports about 1 million cubic meter a day, and there's already a plan to expand that to 2.5 million cubic meters a day, and then there's a feasibility study going on to further increase it to 6 million cubic meters a day.
Understood. Okay, sir. Thank you. I'll rejoin to you. Thanks a lot.
Thank you. Participants, please restrict yourselves to 2 questions. For any further questions, kindly rejoin the queue. The next question comes from the line of Charvin Chandrasekhar from Share India Securities. Please go ahead.
Yeah. Hello, sir. Thank you for the opportunity. So my question was, will there be any effect on the working capital days of this merged entity?
Yeah, the working capital day of the merged entity will definitely get reduced, as Oilmax is a negative working capital business where the oil and gas are being currently sold, the oil is being sold on cash and carry basis, and the gas is a cycle of 15 days billing and the payment of 7 days. So Oilmax is a net negative working capital company. So it will increase the overall working capital. It will reduce the number of working capital days on the merged entity basis, and it will significantly improve the financial position of the company in terms of the assets, net worth, and other financial leverages and strengths.
Okay. Thank you, sir. And another question is, are there any like comparable peers that we can see in this listed space?
For the combined entity, merged entity, I don't think we have come across any peer, but yes, pure E&P companies, there are a couple of pure E&P companies who operates and trades in India. Yeah, but for combined entity, unfortunately in India, there is no combined entity which has a ownership of assets also and a significantly large services business also.
Okay, that answers my question.
Thank you. The next question comes from the line of Pranjali Rao from Nivesa India. Please go ahead.
Hello, am I audible?
Yes.
Yes, please go ahead.
So I just wanted to know, are we bidding for any small blocks out there in India for further development and production?
I mean, bidding pipeline, as you would imagine, is a continuous process, and as the opportunities come, we continuously evaluate, and if found suitable, we bid for them. So there is currently a discovered small field round going, is open in India, and we are definitely evaluating it.
So if you can throw a number.
Number is a very difficult thing, I mean, there are multiple fields on offer in the discovered small field round which is going on right now. So it's under evaluation, and we still have few months to bid. But all I can tell you, there is fields in Gujarat, there are fields in Assam, there are fields in Krishna Godavari Basin, Bombay offshore. So there are multiple fields on offer.
So are we going to do something around rare earth metals? bidding related to that?
We are exploring that business, as I mentioned in my talk earlier. We're definitely interested in exploring the business, but I wouldn't go too far to say that we are ready to bid. We're learning and exploring that business right now. Quartzite, as I mentioned earlier, a quartzite mine was a good entry for us to understand that business.
Got it. Got it. Thank you, sir.
Thank you. The next question comes from the line of Vinod Darji, an individual investor. Please go ahead.
Hi, sir. Thank you for the opportunity and congratulations on the merger. I have a couple of questions, especially with respect to the valuation that was given to Oilmax, right? As per the financial shares, I think the ratio is 50 times trailing earnings, right? So could you please give us a light on what is our rationale to pay such a high multiple, especially for a related promoter group entity that we are merging with? Secondly, because of this merger, now the promoter holding will drop to about 46-47%, or you can correct us if otherwise. So any plans to do any more fundraising or any intention from the promoters to increase their shareholding beyond 50%? Thank you.
Thanks, sir. To answer your first question, the valuation has been done by the independent valuer appointed by both the boards. So they have done the valuation taking all the possible parameters for the companies. Just to highlight you, as I mentioned on the call also, Oilmax valuation has been done by the independent valuers based on the DCF method, which is the risk-adjusted DCF method for all the assets along with their proven reserves and potential risk-adjusted factor. So they have done the valuation, and the fairness opinion has been also provided by a particular merchant banker, and both are very reputed professionals. So the board of both the companies have accepted their valuation methodology, which is a very conservative valuation approach. And to answer the second question, the promoter shareholding in the merged entity on the fully diluted basis after conversion of all the warrants and ESOP will drop down to 47.3%. It's pretty premature to tell right now whether the company will go for the next round of fundraising or whether the promoter intend to increase their stake or not. Both the companies remain well capitalized and the cash flow generated business and sufficient assets, and are fully equipped to pursue their next growth for next 2 to 3 years. At appropriate time, when the company is growing much faster than what we have anticipated and there is a need for the capital, at that point of time, the board of both the companies will decide which is the best way forward for company to capitalize the growth.
Thank you. This is very helpful. And sir, I think I missed your earlier point. Will it be possible for you to share the projections for Oilmax, given that it must have been used in these valuation exercises?
So whatever is permissible as per the laws and everything will be made available into the public domain, and that will be made available to all the shareholders and public at large.
Okay. Thank you. I'll rejoin the question you said. Thank you so much for the clear answers.
Yeah, thank you.
The next question comes from the line of Prashant Agarkar, an individual investor. Please go ahead.
I'm Prashant. Actually, I had got the answer from all previous questions, so right now I don't have any question. Thank you very much.
Thank you.
Thank you.
The next question comes from the line of Bala Subramaniam from Arihant Capital. Please go ahead.
Hello, I'm audible, sir?
Yes.
Yes, thank you, sir. Thank you so much for the opportunity again. So this South Rava CPM block is under development. I think this block have some mixed history. What are the specific technical challenges and gas offtake plans for this block? And is there any pilot production has been successful at this point of time?
So this field, as I mentioned earlier, is under development, and it will take about two and a half years to start commercial production from there. So we have looked at all the available data around, and the block looks very promising. But no test production has started yet.
Okay, sir. Okay, thank you. Sir, on that policy tailwind side, you mentioned about ORDA bill and MMDR Act and this National Monetization Pipeline. I just want to understand what kind of material impact of these policies and what kind of opportunities we have on the basis of compliant entity.
So I mentioned about discovered small field policy, and I think just to some participant asked the question, so as we were explaining that we are looking to bid in the discovered small field round which is currently open, and some decent sized fields are also on offer in the current discovered small field round, which is provide significant opportunity to companies like ours. As far as the ORD Act is concerned, I mean, there are two, three big advantages now that it's mandated by law that the fiscal guarantees will be there. So in the past, as you may be aware, that government has applied some special taxes and the oil prices or crude prices went up. But now the ORD Act provides stability through the Act of Parliament, which is very comforting to a lot of investors. It also provides simpler litigation measures in case there is a problem. So combined, these two, three things together has made the sector more attractive for potential investors.
Thank you, sir.
Thank you. The next question comes from the line of Vinod Darji, an individual investor. Please go ahead. As the participant has dropped from the queue, we'll move to the next participant, that is Ashwani Agarwal, an individual investor. Please go ahead.
Hello.
Please go ahead.
Yeah, I just had a couple of questions. Firstly, right now, does Asian is employed as a O&M or any other service provider on any of the fields of Oilmax?
Asian is operating all the oil fields of Oilmax, including Amguri and Indore, as I mentioned earlier.
So after the merger, the revenue of this will not be coming in the books, if I'm correct, but then that also means that the margins will increase, right?
That is correct, but in any case, those revenues are insignificant compared to the overall top line of Asian Energy.
Oh, okay. And the second question is exactly not related to the merger or the scheme, but on the recent GST rate changes, if you can tell a bit about that. What my understanding is that the rates have changed a bit from 12 to 18. Is that correct?
Yes, you are right. Unfortunately, government has changed the GST rates for the oil and gas industry from 12 to 18%. But now there are two aspects to it. We just talked about the contract similar to like Vedanta contracts or the third party O&M contracts we have. There we will be cost neutral because the client will pay for the GST. The issue comes when we have the field ownership because as you are aware, oil and gas is not covered in the GST. So there we will be looking at changing some strategy and see how we can optimize it. But unfortunately, you are right, GST has been increased.
And just to add, when the intercompany revenues and services have been provided, the GST is an incremental cost to the companies. So definitely with the merger of both the companies and combining their capabilities, there will be inherent benefits in terms of plugging off the tax leakages of intercompany billing and intercompany GSTs. And as far as for the overall E&P companies, definitely that will be an additional cost to all the E&P companies, not only to us, but to across the sector. And earlier also, those costs have been recovered and we will continue to recover those costs from the clients.
Yeah, one question was regarding the valuation. As per the presentation, the valuation is 2,500 crores or something. But the new is it right that we are issuing 4.22 crore new shares?
So the overall share, so as we explained you, The swap ratio is 117 shares for every 10 shares of Oilmax held. So on the fully diluted basis, whatever the Oilmax shares are there on the date of merger, those shareholders will be issued new shares. And Oilmax is currently having a shares of roughly around 2.72 crores in Asian. So those shares will get cancelled. So on the overall, on the fully diluted basis, including all ESOPs and all warrants conversion, the revised capital base of the company will be roughly around 9.2 crores. So in the net basis, the overall incremental shares will be issued roughly around 4.25 crore.
Okay, thank you.
Thank you. The next question comes from the line of Dalpat Mehta from Sun City Advisors. Please go ahead.
Yes, sir. My query is again regarding the valuation. So you have mentioned that you have taken the base as the basis given by the registered and approved valuer. So we can't say more about this, but apparently it seems that the ratio is not justified towards Asian shareholders. Can you throw some light or some base at how you have justified this ratio?
So, the registered valuer had given their valuation. So we are not challenging registered valuer valuation, but they have followed a very conservative approach, and they have provided the necessary discounts of lack of marketability and everything, which are the normal standard industry practices, to provide the advantage to the retail shareholders of Asian. And as I told you, the valuation has been done based on the discounted cash flow of the assets which currently Oilmax owns. So the valuation has been done by the registered valuer, which is and they are very reputed and based on the industry standard practices on the very conservative basis. And after providing the necessary benefits and discounts to make it more favorable to the Asian retail shareholder, and that's why it has been accepted by both board of the directors.
Yes, sir. As I said, we can't argue on the valuation, but apparently it seems that it is biased for the shareholders of Oilmax and not in favor of Asian, because Asian is a already listed company and Oilmax is not a value unlocked. It's a log. So there should be some benefit to the existing shareholders. So
that's
okay,
what I told
whatever you have accepted, I can't argue on that, but it seems that it is not justified.
So let me repeat to you, the valuation by the registered valuer has been made in the favor of retail shareholders of Asian by providing the necessary conservative parameters for valuing Oilmax and providing necessary discounts in the overall valuation of Oilmax to provide a better opportunity to Asian retail shareholders and to bring the overall synergy. So I do not want to comment further whether the valuation is justifiable or not, but definitely the valuation has been done in the favor of Asian retail shareholders by providing the necessary conservative valuation standards and discounts to the market practices to provide a better opportunity upside to Asian retail shareholders.
Thank you, sir. The next question comes from the line of Vinod Darji, an individual investor. Please go ahead.
So thank you for the opportunity once again. A follow-up question to the questions that I had raised earlier. As part of this deal, is there any debt or guarantees or contingent liabilities that we will be inheriting from Oilmax to Asian Energy? And if so, what is our repayment plan or how are we thinking about this?
So there are no contingent liabilities in Oilmax books. In fact, Oilmax has provided guarantees in excess of 150 crore rupees to various bankers to support Asian Energy banking facilities and everything. So, and Oilmax is a cash-rich company, is a net cash company. So the entire company will get consumed in Asian. So there is no additional liability will be coming to Asian books, and the Oilmax corporate guarantees which Oilmax has provided to support Asian business and Asian growth will, once the company get merged, so then those corporate guarantees will get cancelled because the lenders and everyone will have a direct access to Oilmax cash flow there.
Correct. Very helpful. And sir, related question, is it possible to share any other financials beyond what is there in the investor presentation? I know I touched upon this in the earlier question. You said that since it's a cash-rich company, is it possible for you to share any metrics or I think you've shared what it is allowed as per the regulations.
So we'll discuss with our advisors, and whatever is allowed as per the regulation will be shared with all the public shareholders.
Fine. Sure. And the last question, does the Cooper acquisition gets impacted positively because of this merger that we are proposing? Just trying to see how should we look at the Cooper acquisition that you made.
So as we told you, the Kuiper acquisition, which has recently concluded on the 1st September, which provides us a global platform to expand our O&M services across the clients which being served by the Kuiper. And with the Kuiper acquisition coming into fold, and we are taking Oilmax technical capabilities also merging with the companies, now we are looking to expand our customer base across globe, getting out from the current India-centric O&M expertise also. And definitely in a longer run, maybe after 6 months, 1 year, we will see the business aspects getting improved because of this. And the Kuiper being a reputed company operating in various jurisdictions from last 10-20 years will definitely help us in terms of expanding the overall Oilmax and Asian combined technical capabilities to the client currently being served by Kuiper only for a specific services.
Thank you. And if I may squeeze in the last question, or I can again join back the queue, there are certain other shareholders as well in Oilmax beyond the promoters that we have. So will there be any lock-in?
Ladies and gentlemen, we've lost the participant, and that was the last question for today. I would now like to hand the conference over to the management for the closing comments.
We would like to thank all the participants for the questions they had. If there are any further questions, please reach out to us and we'll be very happy to answer. Thank you so much.
Thank you. Ladies and gentlemen, on behalf of Asian Energy Services Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.